And thank you all for showing up today to our presentation. I suspect you're all suffering a little bit from post-turkey, exaggerated turkey eating from last week, but welcome. And we're living in interesting times, that's for sure. And now the future of financing energy efficiency projects and what we need to know today, based on the politics, may be a little different tomorrow. So it's all, let's wait and see. But what I'm going to share with you today is pretty much what we know as of this moment. And I'll give you a quick introduction to me and Catalyst Financial. We've been working in the energy efficiency realm since 1992. We've worked with over 25 electric and gas utilities to design and create and implement financing programs. We've worked with the state of Delaware, Xcel Energy, Consolidated Edison of New York, National Grid, Pacific Gas and Electric. And because I'm multilingual, I've done work with the Inter-American Development Bank in Latin America and Peru and other countries. So that said, I have a broad understanding and knowledge of the way to get these projects done. We're coming from working out in the field. So I'm sharing some of my actual experiences with you, what techniques that we've used to actually close deals on behalf of the energy service companies and vendors of energy and related equipment. So thank you for joining. Today's objectives is to talk about and touch on 9 different financing options that are very commonly used in the realm of energy efficiency financing and renewable energy projects. And if you understand some of the accounting impacts and legal impacts of these strategies, they can be used to overcome common management and financial hurdles that you run into in both the public and private sectors. Specifically, I'm going to talk very little about loans, but I will talk about leasing, capital lease, operating lease, tax-exempt lease purchase agreements, very important in the public sector, equipment financing agreements, power purchase agreements, energy performance contracts, energy service agreements, and PACE. In addition, I'm going to go over some detail the Inflation Reduction Act, the acronym is IRA, of course, not to be confused with Ireland, but there are programs that have been developed that really help us move the market in the right direction. Their 179D tax deduction is one. That is different than the 79 with no D, the just plain 79 deduction, which is going to be expiring soon, but I'll give you more details in a minute. Section 48 investment tax credits, great stuff. New energy efficient homes tax credit, and of course the home energy efficiency rebate program. Energy Star and EPA has a variety of financing and tools, resources available to people online. And one of the tools that we help develop is the cash flow opportunity calculator. And that's really a tool that I've used to demonstrate, calculate, and quantify the cost of delay that people are dealing with when they're installing energy efficiency projects, something that many people tend to skip over and not acknowledge that is part of the true cost of waiting. Now, I apologize because I woke up this morning, I had a little bit of a sore throat and my voice is a little bit raspy, but we're going to power through this the best I can. And I hope it's that you hang with me here. So we know about Energy Star, savings opportunities in buildings. I'm not going to drill down on this chart because everybody on the phone today, I suspect, is familiar with Energy Star. I would only make one suggestion, that if you are not an Energy Star partner, click on the hot link in the bottom of the slide, join Energy Star, sign up for it. Your commitment, as you can see there, is benchmarking, implementing plans, educating, communicating, and it comes with plug-in advertising and PR support that has been developed by very talented and skilled PR companies and advertising companies on behalf of Energy Star. So that is something that I urge everybody to take advantage of. But before I get into the different financing structures, I want to go over what we need to understand before we start drilling down and looking at, do we get a loan or a LOS or a lease or whatever. So the first thing that everybody should do is recognize that the proper financing vehicle requires understanding and doing some strategic planning and self-evaluation. And that starts with getting an energy assessment from a qualified service provider. Now, if you have that skill internally, obviously you don't need to do that. Or if you are a vendor, then you are the qualified service provider that we're trying to steer people to. But understand that different technologies lend themselves to alternative financing solutions. So the best way to provide financing to your clients is to understand what some of their needs are, both in marketing and tax strategies, etc. So I'll talk a little bit about that during today's talk. We need to define short and long-term business goals. Do you own or lease the property? Are you growing? Are you reorganizing? Are you static? So it may mean that you either have to reduce or increase the space that you have. More people working remotely, less people working remotely. Questions that we need to ask. And we also need to forecast future cash needs, because the moment you start spending your cash or taking out loans for these projects, what you're doing is you're depleting some of the resources that you have access to for developing your business and promoting your business, which makes energy efficiency financing kind of a unique product. It's the one where you can kind of have your cake and eat it too. Because when we implement energy efficiency projects, we're creating savings. And as long as the savings are greater than the cost of financing, you get positive cash flow. And that is a really big driver for doing these projects. Now, the last little bullet there is understand when you're doing your self-evaluation that even though we're talking about energy efficiency, there's an opportunity to bundle projects to get a better return on investment, especially when you're looking at energy efficiency. You may have some very long-term, slow payback projects that will benefit from a lighting, for example, that is a very quick payback. So you need a kind of a holistic approach to picking your projects. Understanding your financial profile is very important. If you were a lender, how would you score yourself? That will determine interest rates. It will also determine whether or not you have any limitations on debt. And if you've got a lot of bank loans, you may be dealing with conflicting covenants with the existing loans and bank loans that you have. Of course, before you start looking at financing options, seek out all incentives that are possible, both at the utility level, local, state, and federal level. Now, people always ask me, where do we find the money? Where do we find the incentives? So I'm going to put that slide up front. Start with your state energy office. A great place there is the National Association of State Energy Officials, and they have a loan map that will, at the website, you can click on it. It will bring you right to the state energy office, and you can see what programs are available to you locally. Another great website is Desiri USA. It's a database of state incentives and renewable for both renewable and efficiency projects. It's managed by the North Carolina State University. And of course, before seeking financing, the reason why you're with us today is to help you understand better some of the benefits and consequences of different financing alternatives so you can make a better choice for you or your clients. I'm going to start with the Inflation Reduction Act of 2022. And that's a big number, $891 billion total spending, of which $783 billion has been earmarked for energy and climate change. Some of the really important changes that have been introduced by the IRA is a direct pay or elective pay option for tax exempt organizations. In the past, if you were tax exempt and you were getting a tax credit, you couldn't use the credit because you didn't have to pay any taxes. It's a big distinction between a tax deduction and a tax credit. So now that the IRA has implemented some of these elective pay options, tax credits can be transferred and they can be monetized. They're actually brokerage organizations that, if you do have a tax credit, will help you and market and sell that tax credit. Used to be you had to be dealing with mega numbers in order to find somebody with a tax appetite to buy your credit. That has come down considerably thanks to the Inflation Reduction Act. And of course, there's a whole bunch of new tax credits for for technologies that were excluded in the past. And the beauty here is these are available now for nonprofits, religious organizations, REITs, real estate investment trusts, etc., who in the past, like other public sector organizations, could not take advantage of these tax credits. That has changed. Now, the energy security section G is where all these benefits are found. And of course, the tax credits and deductions were designed to promote private sector investments in clean energy technology to reduce CO2 emissions. And we're trying to move the market in the US real estate sector because really they have, they're huge contributors to the environmental challenges that we face today, and we want to help them reduce their carbon footprint. So, number one, deduction to help make commercial and multifamily buildings more efficient. That's section 179D. I'll give you more detail in just a sec. A tax credit to encourage investments in renewable energy generation, storage, and other clean energy. That's section 48. A tax credit to incentivize the installation of EV charging stations, and a tax credit to incentivize energy efficient new residential construction. Of course, there's the homeowners managing energy savings rebate program as well. And as I had mentioned earlier, note that there is a distinction between a tax credit and a deduction. A deduction can be taken right off of your out of your profitability. It can be reduced by the deduction, which means you have to pay less tax. However, a tax credit can only be used if you have a tax obligation, and the tax credit can be used to pay that obligation. So the 179D tax deduction, it expands the deduction to include architects, engineers, design build contractors, and other designers of tax exempt buildings. That includes both government buildings and nonprofit buildings. So that's opened up a lot. It helps building owners, both commercial and multifamily. And as I've mentioned earlier, real estate investment trusts that because of their accounting requirements could not take advantage of some of these rebates, and residential building owners and properties of 4 stories or more are now able to take advantage of these benefits. Now, the benefit does start at 50 cents per square foot for energy savings of 25%, and it goes up to $1 per square foot if you can demonstrate a 50% savings. That's on a sliding scale. So if your savings is in between, you will wind up, getting 75 cents per square foot. And in order to get the bonus, the 5X bonus, you need to comply with prevailing wage and apprentice requirements. If you're not sure exactly what that is, the reason why that's outlined or highlighted in blue is that there's a link there that will take you directly to the federal labor page that will detail exactly what those wage and apprentice requirements are. Now, the prevailing wage is determined by the Secretary of Labor. And of course, it does include apprentice requirements, which means tracking it by labor hours, ratios, and participation requirements. All of that information you can pick up by clicking on that hot link. It's important to note that last year, not many people were taking advantage of the 179D. And the reason was that there's a regular 179 deduction that people could take advantage of without having to do all the tracking uh, that is required to get access to the 179D. That is really being scaled down, as you can see in this chart on the slide. 60% of that is available in 2024, and it expires completely in 2027. So what's left? 179D. That's going to become increasingly important for your customers and your clients to take advantage of. Now, some of the really important changes are the qualifications for retrofits that has been reduced. There's been a decrease in the energy use intensity from 50% down to 25%. Used to be that in order at the 50% level, you could look at lighting, HVAC, water, hot water, building envelope issues separately. But today, with the changes under the new application, you need to take a look at all three of these combined. You can no longer isolate them and find that one of them can trip a part of the benefit. And I think another really important piece here is, when retrofits were being upgraded and remodeled, you needed to provide an energy simulation model in order to qualify for the rebates. That is no longer the case for retrofits. It is the requirement for new construction, but no longer for retrofits. And the good news is that the Energy Store Portfolio Manager, which I hope you're all familiar with, can be used now and to justify the energy use intensity reduction. So that is something that I hope everybody is taking full advantage of. Sign up for it, register your properties, and if you're going to capture some of these tax benefits, certainly under the 179D, that's something that you need to take a hard, careful look at. Now, under Section 48, the investment tax credit, basically providing a tax credit for most property, energy property, of 6%, which we refer to as the base rate. You can scale that up 5 times. So the 5% becomes 30% of cost. So that's referred to as the bonus rate. If the project pays prevailing wages and meets the apprenticeship requirements. Of course, not all assets do qualify, or all products. Microturbines are limited to a 2% base rate. So if you meet the prevailing wage and apprentices requirements, you can bump that up to 10%, which would be the bonus rate. Now, it's introducing technologies that were not really could not take full advantage of this before: wind storage, biomass, geothermal, solar, small irrigation, landfill, hydro, and the list goes on. One of the beauties here is that the tax credits can be transferred to third parties. So companies that had little or no tax liability, that usually could not take advantage of these tax credits, can now transfer the credits to another tax-paying entity that can use them. Of course, there are conditions to it. The buyer has to pay cash for it. But this is a great option for people who had to forego that benefit. For public sector organizations, similar but better, they can be refundable. So the investment tax credit can be paid directly back to the municipalities, school districts, and any other tax exempt entity. And of course, these are subject to a 5-year recapture and a 3-year carryback. So if you're working with an expert in tax credits, or somebody who's familiar with this option, they can work through your history and see if you can recover from projects you have done in the past. Now, it's important to point out that you can stack these alternative energy credits. What do we mean by stacking? Well, it starts with the 5X bonus credit. Project must meet prevailing wage and apprentice requirements or be less than 1 megawatt. Once again, there's a hot link there that takes you to those apprentice overview. Domestic content, 40% of the cost of any steel, iron, or manufactured product that is a component of the energy project must be produced in the USA. And again, there's a hot link to the guidance, IRS guidance. If you're in an energy community, which could be a brownfield site or a statistical area, an area which is being impacted due to extraction, processing, or transport of storage of oil, coal, or natural gas, and has an unemployment rate at or above the national average. And if the third area, there's a census tract. The fourth category there is low income. So if you're dealing with clean energy investments in low income communities, for example, on Indian land, you can also take advantage of stacking some additional credits to that. And here's a chart that will give you an idea of how these do track. So for example, if let's pick a category. I can just go combined heat and power. The base credit is 6%. If I meet the requirements for labor, I can bump it up to 30. If I hit domestic content, made in USA metals, I'm in an energy community, I can bump my 6% all the way up to 50% or a percentage thereof, depending on how the numbers shake out. And it goes all the way down the line there. As you can see, based on any particular project that you're looking at installing, you can see how you can save or get back as much as, in some cases with small wind, up to 70% of the project cost. The same thing with solar. So these are really big incentives that I trust people are going to take full advantage of, even before you start looking at how you're going to finance it. Now, the 45L new energy efficiency homes, they extended the rules through 2032. They must be certified under the Energy Star program to be eligible for up to $2,500 tax credit. And of course, these things are all subject to updates. For dwelling units certified under the Zero Energy Ready Homes program, the credit is increased to $5,000. For multifamily units, it's decreased to $500, and the Zero Energy multifamily units are $1,000 each. However, if the multifamily units do meet prevailing wage, that can be increased. And the interesting thing here is in the 45L, while prevailing wage is a requirement, there are no apprenticeship requirements that are attached to this. And I don't know why they did it that way. It may have been an oversight, but that's something that hopefully you can take advantage of, because your paper trail is critical in order to be able to capture these tax credits, rebates. Now, the IRS Section 5121 Home Energy Rebate Program, that's set aside $4.3 billion to the Department of Energy to award grants to state energy offices. This is why I suggest in the beginning that you start looking to your state energy office, because the most recent changes and new programs are directed, and the state energy offices are aware of all of the current programs that you might be able to take advantage of. They're focused on developing and implementing a home energy management savings program. And of course, they're looking at promoting this for households with incomes below the 80% of median income. For single and multifamily homes, you've got the home efficiency rebate program and the home electrification appliance rebates programs. Rebates are rebates. They reduce the upfront cost. I have to take a sip here of water. Excuse me for a second. Cold sneaking up on me. And the rebates provided under the Homes Rebate Program cannot be combined with any other federal grant, and this is going to be available until 2031. So that's something that I know people are concerned about what changes might be happening now with the change in government that's coming up with all these energy efficiency financing programs. But we don't know what's going to happen. What I can say is that if something has already been funded, the program's been funded, highly unlikely that those programs will go away. They will not disappear. And for more detailed in IRA implementation details, U.S. Department of Energy, the Renew American Schools program has a wonderful presentation that they recorded. So if you're concerned about, how do I apply for these tax credits? What do I need to do? I would strongly suggest that you click on that hot link and listen to the presentation. You're going to walk away understanding that that including tax on IRA experts early in your planning process when pursuing IRA's tax credits is really important because the process can be uber complicated. So a lot of tracking that is required. So, underscore that. And of course, dealing with the National Association of State Energy Officials, they have a great resource hub linked there in the slide. And by the way, you're all going to be getting copies of the slides. So you can actually implement the links once you get your copies. We'll talk a little bit about green banks because they're always and becoming an increasingly important source of funding for projects. Very important, especially when you're dealing with an innovative financing requirement, because either your credit profile is not strong enough, you may need some additional support in order to get the funding that you need in order to implement the project. So they're a very interesting resource that people should be taking advantage of. They use public capital to mobilize private investments. So they're going to take seed money that comes from either the federal government or the local or state governments, and they're going to leverage that with outside sources in order to allow investors that might normally not be so willing to undertake a project or invest in a project to help make them feel more comfortable that this is going to be a successful project that will pay out in the end. There are currently 23 green banks in 17 states. And, the Inflation Reduction Act provided $27 billion in grants for the EPA to establish greenhouse gas reduction fund. That's already been allocated. So those monies aren't going away. There's a National Green Bank Network. And of course, part of the focus there is to enable low-income and disadvantaged communities to help them take advantage of becoming more energy efficient. Now, this is a map where you can find your green banks that came directly from the Coalition for Green Capital's website. They are the originator of the green banking concept. They wrote the legislation that has been adopted so that green banks can actually help motivate and transition the marketplace. So they've done some marvelous work. They're a great resource. Keep them in mind. Don't want to forget about the Infrastructure Investment and Jobs Act. Now, I know that's not part of the IRA, but there is money available in the Clean Water State Revolving Fund, and they've got up to $23.4 billion in federal and state partnerships to provide low-cost financing to communities for water infrastructure projects. And as you can see the list here, municipal wastewater, pollution, storm water runoffs, green infrastructure, water reuse, etc. So if your projects fall into that category, don't overlook that, even though it's not part of the IRA. Now let's take a harder look now at some of the financing alternatives that you would be able to take advantage of. And I want to point out that when I talk about financing structures, that is different than sources of funds. Financing structure is what is the document you're signing in order to be able to get the money into your organization to invest in the project and how you're going to repay it. And the source of funds is who's going to provide the funding. So even though you have, you can identify a source of funds, they're going to be using a financial structure. So they are similar, first cousins, related, but they're not the same. So we look at my energy efficiency map, and we introduced this map a long time ago, and I've seen many variations of this pop up through different organizations. But this is the original map that we created. So if we're looking at energy efficiency financing, obviously, if you're going to use internal funding, not relevant. Bonds, green bonds, they're becoming increasingly important. Green bond can access financial benefits in large part due to the IRA that is happening. But unfortunately, the green bonds have not kicked off as aggressively here in the United States as we would have liked to see. While in Europe, they're very popular. Actually, Europe generates more green bonds than any other region, but they're available. And I'm not going to spend time talking about bonds because that is the subject of a whole other webinar, at least an hour, because that can be very complicated. We are going to talk about the more traditional financing options, as well as some of the specialist ones. And under traditional, we'll start with leasing. You got the old capital lease, now it's referred to as a type A. We have the old operating lease, a type B. And the most important of the three, especially for tax-exempt organizations, is a tax-exempt lease purchase agreement, which has lower interest rates, and I'll detail that in just a sec. In terms of loans, I'm sure everybody at some point or another has taken a loan for something, a car, an education, a house. So I'm not going to deal too much with that. Commercial loan, different category. And a lot of vendors are offering loan equivalents in terms of an equipment financing agreement. That's a conditional sales agreement. You buy the asset, you make the payments at the very end, the title of the asset transfers over to you. Under specialized financing, we've identified solar leasing as a standalone category. You'll notice that there's a little lightning sign there because that's mostly used for renewable energy projects. You can combine efficiency with solar, but that requires some careful planning and working closely with your developer in order to make that happen. Of course, we've got regular loans under specialized, but we're really looking at loans that can come through the utilities, and there are two different kinds here: OBF, on-bill financing, and OBR, on-bill recovery. What's the difference? Well, on-bill financing is money that's being provided directly by the utilities themselves. On-bill recovery, the utility is working with a third party, they're providing the funding, and the utility is servicing the loan and adding it to your electric bill. Now, these loans typically are below market. So if you do have access to a utility OBF or OBR, take a hard look at that. Again, all that information you will find on the earlier slide about Desiree and your state energy office. We'll tell you where if that's available to you. Of course, there are specialty funders who work almost exclusively on energy and energy efficiency projects. The one that comes to mind is the National Energy Improvement Fund that really understands how to work with, in their case, smaller projects, homeowners, etc. PACE, divided into two categories: commercial and residential, energy service agreements, an EPC and performance contract, traditional energy service agreement, energy as a service, and power purchase agreements. I will drill down on each one of those shortly. Let's start with the cash. Kind of skip over that one because that's pretty obvious. The owner writes a check. It's really fast. The only big negative there is once you write the check, you don't have the money to invest in other income generating projects. And most organizations are not focused on energy efficiency, although that is an important part of their marketing and outreach programs, but they're really interested in generating more profit. and generating more profit normally starts with selling more product or improving their margins. Of course, energy efficiency will improve margins, and we have some tools that will help calculate that. Of course, it has maintenance responsibilities and project risk management. All of those two can be contracted to a third party, and that's consistent pretty much across the board. So when we take out a loan, most people think of taking a loan out from the bank. And if you go to the bank for a loan, typically they can provide some of the lowest borrowing costs short of paying cash. And the investment tax credits would go to the owner. It's very clear that the owner would qualify for it, even though they're financing the project. What are the cons? Similar to paying cash, that you take the money away and you're now competing against other capital projects with your energy efficiency project, which you don't want to do. I think energy is strong enough to stand on their own. It's the cake and have it, eat it too argument that I shared earlier. It reduces existing credit lines and often has restrictive covenants. If you're dealing with the bank, you're frequently signing an agreement that is pledging assets of the organization, not just the energy assets that are being financed, but the overall assets of the entity. And in that case, it's common to find restrictive agreement. What does that mean? Well, it means that the bank's going to want to, or the funder's going to want to see how you're doing. So they may require you to provide financial statements to them on an ongoing basis. And in the financial statements, they got to track your return on investment, all of the traditional ratios that they would look at in order to decide whether or not your credit risk stays the same, is up or down. And if it goes down too much, they could call in the loan. That could be a cash flow catastrophe. Now, they usually require large down payments. And of course, internal politics, you can never get away with that. Maintenance and projects management, I shared with you before, consistent across the board in these cases. Now, an important word about off-balance sheet financing, and a lot of when I'm dealing with clients, most of them, not all of them, do ask for off-balance sheet financing. Unfortunately, not everybody truly understands the consequence of that and the benefit of it. It means that a company, when they enter into a debt, they're not including the debt as a liability on their balance sheet. It's an accounting term, and it does impact the company's level of debt and liability. So if you can avoid additional debt because you've kept something off balance sheet, you can improve your financial ratios. I mentioned some of them before. Well, here's profitability, liquidity, leverage. That's a common one. Debt to equity, efficiency, inventory, and net working capital. This is just the sample. Now, at the very end in the resource page, if you're interested in learning more about that, there's a link so it can take you to a source that would explain a lot of these ratios better. And of course, if you can keep it off your balance sheet, that typically lowers your borrowing costs. And the most important, it can potentially avoid breaking lender covenants, which is part of your lender contract. Now, what happened in 2001? Enron happened. I don't know if you've been around long enough to remember Enron, but they created a financial catastrophe by, without getting into any great detail, by misstating operating leases and loans on their balance sheet, which eventually caused them to go bankrupt. So the Financial Accounting Standards Board, FASB, they changed the rules by creating special asset and liability categories for operating leases. So in the past, they did not show up on your balance sheet. Today they do. They show up, but as under a different category, right of use and liability, which is the net present value of your payments. So it's not exactly the same, but there are other alternatives to operating leases that can keep some of these energy investments off the balance sheet. And we'll talk about those in just a minute. Important to talk about leasing because a lot of these projects use a lease structure to fund itself. That's a lease to own, means the asset typically transfers, ownership transfers at the end of the lease. $1 purchase option is a giveaway that would be a capital lease. The economic characteristics of the asset ownership for tax and financial reporting purposes is exactly the same, whether you own it or you loan it or you lease it. So some of the pros gives you access to new credit lines. Really important to the structuring flexibility. I've only indicated two variations, step lease and a skip lease. So if you're thinking about leasing, it's important to deal with a leasing organization that really knows their stuff. What's a step lease? Well, step lease is very common in the energy world because as we install energy efficiency equipment, the savings go up as we do our installation. The more we install, the more we save. So you can structure the lending, or the lease in this case, so that the payments increase as the equipment's being installed. And that way you can guide your repayment so that the savings directly cover the cost of the installation. So that keeps your other capital lines and the CapEx programs intact. So that's important. What's a skip lease? Well, we did one on behalf of one of the New York State utilities for an amusement park where they were open in the summer and closed in the winter. So we had a skip lease. In other words, they made high payments in the summer where they had lots of cash, and they made contact payments in the winter. Hello, we send you an invoice. I'm still here. I'm still breathing. But we tied the repayment into the cash flow of the client. Leasing typically does provide 100% financing. Depreciation to interest is deductible. Excuse me. It's secured by the asset being financed. However, because it's secured only by the asset being financed and not a blanket lien on your company, financing costs may be slightly higher than if you're taking out a loan, if there's a blanket lien on other assets in the organization, in case of default. Of course, project management, maintenance, and approval consistent across the board. Now, the old operating lease, type B lease, very similar. However, the asset ownership stays with the lessor, the lender, and not the borrower. So the lessee is the borrower in this case. They can purchase the asset at the end of the lease term. So basically what they're doing is they're renting it for a period of time with the option to buy it at then fair market value at the end of the lease term, or you can renew the lease or return the asset. Pros, similar to the other leasing benefit, new credit lines, structuring, flexibility, 100% financing. In this case, they may be tax deductible. Now, tax deductible doesn't necessarily mean off balance sheet. It means tax deductible for IRS. That would be the tax lease up here that I'm referring to. And it is secured by the asset. Now, one of the big negatives, well, let me check that. So it's no longer off balance sheet, as I mentioned before. Now, one of the big negatives was that the investment tax credit could not be used by the lessee, but that has changed with the IRA. And of course, project management, maintenance, etc. Properly structured tax lease payments can be expensed for IRS purposes. They still will fall on the balance sheet. Solar leases usually fall into this category, but not always. So let's take a quickly look at the difference between taxable and tax-exempt leases. So when we talk about tax-exempt leasing, that's implying a lower interest rate. Why is it lower? Because no federal income tax is paid on the interest earned by the investor. So because we're in a free market, if there's no income tax on it, Bank A may be competing against Bank B. They both have no income tax paid on that, and they'll reflect that in the price. So the pricing will come down. Public sector's organizations can issue tax exempt. That's something that's been determined by the Internal Revenue Service, and it typically includes having the ability or power of eminent domain, taxing powers, police powers. The example I've used in the past for police powers, there was a private university not a public sector university, private university, who had police force, campus police force, who entered into a tax exempt lease. And guess what? The IRS declared that they did not qualify under the IRS definition. And what happens if you write a tax exempt lease and your tax exempt status gets disqualified? Well, it gets recalculated at taxable rates, and all of a sudden, the party who is the lessee in this case would have a substantial bill come due for making up the shortfall. So it's very important to make sure that you do qualify. Now, private sector and large nonprofits can qualify. They have to go through a conduit agency in order to issue tax exempt. An example would be DASNY, New York, Dormitory Authority of New York State. Cornell University, private university. If they want to issue tax exempt debt, can they do it? Yes, they can. They would go through DASNY. DASNY would charge them a small fee for doing it. But at the end of the day, that small fee gets bundled into the cost of financing. And the overall result is that they paid lower monthly payments for issuing the tax exempt obligation. And of course, it used to be that public sectors do not pay taxes, but this has been changed. So the rules has turned this big negative into a giant positive. Should probably change the emphasis on that the next time I revert to slide. So what's a tax exempt lease purchase? It's an installment purchase, a conditional sale. It's a lease with an option to buy for nominal value, ergo the $1. It's also referred to as a municipal lease. It can only be issued by a state or political subdivision thereof, like a city or a town, school district, etc. And for some not-for-profit organizations. Now the pros are interest rates are lower. I explained that already. And structured flexibility, that continues. It's a lease. Usually does not require referendum for approval. That's important. Why? Because payments may be subject to the annual appropriation of funds. And if it's a lease that renews year to year to year, which is basically what we're doing here, if we don't approve appropriations or appropriate funds for the project next year, don't have to keep on paying. If you don't have future obligations, legally it's not considered debt. If it's not considered debt, the steps that you need to take in order to get it approved are much easier. And with a tax exempt lease, if you're looking at a relatively small project, the true investment cost, the TIC, is usually lower than it would be if you issued a bond for a small to medium project. You issue a bond, you have to set up sinking fund, you have to set up loss reserves, you have to do insurance. The legal requirements for documentation are considerably higher. So there are a lot of extra fees. You wind up overfunding a bond. So if you have a $20 million project, by the time you add in all the extra fees, your $20 million is no longer 20 million, maybe 21 or 22 million, depending on the complexity of your project. And of course, the asset goes to the borrower at the end. Politics, always a question. This is IRA benefit. I can't underscore it enough how important that change is. And of course, the other standard requirements of maintenance and management. So let's talk about an equipment financing agreement. It's really conditional sales agreement. Typically, you find this through your equipment vendors. Very similar to a loan. It will can provide you with new credit. They will finance 100% typically. You can deduct interest and depreciation. It is secured by the asset being financed. And of course, any tax credits goes directly to you. And the approval time may be faster than if you were going to a bank to get them to approve it. So if time is of the essence, take a hard look at EFA or conditional sales agreement. Cons, because it's secured only by the asset, financing costs may be higher than a loan. And of course, the same maintenance and project management goes across the board. Let's take a quick look at energy service performance contracts. It's a service providing customers with a comprehensive set of energy efficiency renewable energy and distributed generation measures, often accompanied with guarantees that the savings produced by a project will be sufficient to finance the full cost of the project. This implies working with an ESCO. Some of the big pluses: comprehensive measures and turnkey services. They will provide or give access to project financing, but that's typically done under a separate agreement, because we are dealing, especially in the public sector, if you're dealing with the public sector entity, they can borrow cheaper than if the ESCO or the energy service companies were to provide the funding internally, which they could, but they would have to go out and seek financing, and they're going to mark it up, bundle it in. So you're frequently better off just separating the financing and treating it as basically two different kinds of agreements: your technical agreement and your financing agreement. There is a project savings guarantee that comes with it, and the ESCOs usually provide monitoring and verification, which is important because you want to make sure that what you started off with is what you're ending up with. Of course, careful review of the contracts is critical. They're more complex, and you want to make sure that you're only getting the services that you want and what you need. Well, similar, first cousins, an energy service agreement. That's one in which the equipment is owned and operated by a third party or an energy efficiency company and not the host. So financing costs are bundled into the fee for service. Pros, no upfront costs. It's managed and maintained by the third party. We finally got away from that. And it could be considered off balance sheet. Some of the variations here: traditional energy service agreement, in which the equipment is owned by the energy service company and the owner pays the bills and reimburses the ESCO based on performance. Energy as a service, EAAS, it's a monthly service payment which includes equipment upgrades, replacements, manages bills, and suggests alternative energy sources. It's really a pay-for-performance kind of a contract. Now, this has been around in Europe for at least 20 years, and it's becoming a more popular vehicle here in the United States over the last 3 or 4 years. So this is something that merits investigation, especially if you need to keep the project off balance sheet. Now, I shared with you earlier some of the challenges with off balance sheet interpretations. Understand that if you need to keep something off balance sheet, the probability of the financing costs will be higher than it would be if you didn't have that requirement. And the organization that's requesting off balance sheet treatment needs to recognize the benefit keeping it off balance sheet and put that into the calculation when they're looking at different ways to fund their project. Last one there is the energy assets concession. I only mentioned it because at one point somebody asked me about it. These are pretty infrequent. They require huge projects, multi-million dollar projects. They're very long-term, much less common. Basically, an energy asset concession is an organization like a university would be leasing their energy assets to a third party who will take over the control and management and running of all these assets, for which the third party will pay the university upfront for taking over and leasing those assets. But again, very complicated, and I have rarely seen them. But they do work if the project is large enough and the cash need is large enough of the borrower. Quick talk mentioned about PACE, low-cost long-term funding for energy, water efficiency, renewable energy projects. Its PACE financing is repaid as an assessment on the property's tax bill, and it's processed the same way as any other local public benefit, like your sidewalks, sewers, street lights, and they've been doing that for decades. Now, there's a distinction between commercial and residential PACE. The more popular one is on the commercial side. Residential ones are possible, but they're more complicated. Why? because of this little bullet over here on the cons, may require first mortgagee approval. What does that mean? Well, whoever's carrying the mortgage on your home has to agree that the loan that you're taking out for the energy efficiency takes priority over the repayment of your mortgage. So there are some lenders that do that, but that typically has been the stumbling block. It's a lot easier to do when we're dealing with commercial base. It's a voluntary program. They'll fund up to 100% of the asset costs. They can take the financing out to up to 30 years. That allows for really deep retrofits. It's a big plus. Can be combined with other incentive programs. So take advantage of the rebates and discounts. It may stay with the building upon sale. That's an interesting benefit, because if it stays with the building, it's not technically debt of the building resident. Therefore, it could be considered off balance sheet. So this is one of those options where if off balance sheet is a requirement or a great benefit, this is one way to do it. And in order to have access to it, it requires state and local enabling legislation. Property assessments are paid once or twice a year, which means you need to set up a sinking fund, not like a loan where you pay every month. And the interest rates may be higher than alternative sources of funding because of the complexity of the agreement, the longer term, etc. But this is a very viable alternative looking for funding for your projects. Now, here's a map of where these programs are available. And I've highlighted on the left side there, a little residential base is in California, Florida, Missouri at this point. Of course, these things are dynamic and they're changing, but as of today, that's what we have. What's a power purchase agreement? Legal contract between electricity generator, provider, or purchaser, buyer. It's very commonly found using with CHP projects, for example, that would provide both electric and hot water at the same time. And of course, that's where a lot of the savings kick in. Minimal upfront capital costs to the host. Gives you the potential to monetize tax incentives, and that has changed a little bit. Make a little note here. Update that next slide. It's a typical long-term energy price, so it takes the variations away from that for planning purposes. There are no obligations for operation or maintenance, and it's relatively risk-free. Now, of course, there's nothing is totally risk-free. There are risks here. And the risk can come in terms of overpayment if the markets work against you. But they're complex contracts. The terms may not be consistent with what you want, because the owner of the asset will start dictating terms to you. The transaction costs are higher because the organization that's going to enter into the power purchase agreement is going to want to double check the engineering. After all, they're buying the project, so they're going to run the numbers with their own people. You may have some challenges with contract terms and conditions. For example, a common issue that we have seen is they include take or pay language. So if the project doesn't generate enough savings, the contract may call for the organization to make a minimum payment in order to make the numbers work for the investor. Time to approve the project is typically longer than it would be if you had gone to a bank or a more traditional lender. And the investment tax credit is frequently used by the provider, but that's something that's today in today's world is negotiable. And as I had mentioned, there is a risk of overpayment under power purchase agreement. In general, these agreements are perfect for things like CHP, solar. Those are made for, this agreement is made for those two types of projects. Now I'm going to give you a list here of pros and cons the ones that I just gave you are the most common ones. It's not intended to be all inclusive. This keeps our attorneys happy. Hurdles, blocking installations. This is where we get into how do we pick the right financing vehicle to overcome some of the hurdles. They fall into two categories. Operational, you got no staffing, you don't have the understanding, too risky, it's not sure that how it's going to work. We have other priorities. We need to deal on increasing sales, and it's just not our core business. I don't want to have to deal with that. Those are your traditional operational hurdles. Your financial hurdles. It's too expensive. We can get cheaper equipment. However, the savings will be less. And that may or may not be a good decision. Typically, it is not a good decision to put in cheaper equipment with less savings. You may not be able to take on new debt because of existing bank covenants. We talked about that earlier. Oh, my credit worthiness, we're having a tough time right now. Our market's soft. So our finance performance is not as strong as we would like. Or, oh, the return's too low. You know, we're not going to invest in energy efficiency when we can focus on other income producing projects. Again, we're back to the have your cake and eat it too with energy efficiency. And this is an argument that could easily be overcome when you look at the cost of delay. And as I mentioned earlier, if the savings are greater than the cost of financing, you got positive cash flow. That's a big plus. They have capital budget constraints. You know, how many times have I heard, oh, we have to wait till next year, we're going to put the funds in the capital budget. And the payback's too long. You know, it doesn't meet our return on investment thresholds, which is typically 3 to 5 years, more frequently 3 years or less. So a lot of the energy efficiency projects don't meet the 3-year or less threshold, and certainly if they're comprehensive, they will not. So how do you use financing to address these? Well, I went over the cash, the loans, leasing, capital lease, operating lease, power purchase agreement, EPC, ESPC, ESA, and PACE. And as you get down the list of these hurdles, you can see which ones of these agreements, if you identify your challenges, your operational challenges on the left, and see which is the best that will help meet address your needs, and your financial hurdles you can see underneath, and you can see how some of these financing structures will help you address some of those. Now, there is a paper that we wrote in conjunction with the Maryland Energy Office. That's You're Getting to Yes with Energy Efficiency. And there's a link to that paper on the resource page at the end. And I'm going to double up on saying, hey, how do you calculate the cost of delay? That's the Energy Star Cash Flow Opportunity Calculator. I'm going to give you a quick run through for that right now. So Energy Star tools. Start with the Building Upgrade Financial Calculator. And this is one that evaluates the cost and benefits of efficiency investments for both the owners and each tenant. This tool really deals with one of the primary challenges people have, which is referred to as split incentives. Split incentives. The organization that pays for the energy improvements may not be the organization that benefits from it. Typical, if you have an office building that does not have independent meters on their lessees. So how do you justify spending money on energy efficiency if the lessees are the ones dealing with the benefit, but they're not, and covering out-of-pocket costs for doing the installations? Well, this tool quantifies the expected changes of the expense reimbursement under common commercial lease structures. It generates paperwork that deals directly with the split incentive barrier, and it opens dialogues, hopefully, between the landlords and the tenants to share savings from the capital investments. This actually used and BOMA's energy efficiency program, course 5, business case. So it's a tool that we know works. And if split incentives is your problem, highly recommend taking a hard look at it. As you can see down here, you can has a hot link there, you can get directly to the tool. Cash flow opportunity calculator. This happens to be one of my favorites, and probably that's because I wrote most of the underlying algorithms that are in the agreement. This reflects our real life experience out in the field with closing deals on behalf of energy service companies and vendors. And it can go toe to toe. It addresses we don't have the money objection. It translates energy savings into financial speak. You know, financial guys speak in dollars and cents. Energy people tend to terms of kilowatt hours and therms. And most importantly, it quantifies the cost of delay. And it answers 3 questions. How much new equipment can you buy from the savings? Should you do it now, finance it now, or wait and use cash from a future budget? And would you lose money by waiting for a lower interest rate? Those are the 3 questions. Well, surprisingly, some of these are counterintuitive conclusions. Now, the CFO does cover all market sectors, including public sector, which is where it started. But the arguments are the same for residential, commercial, industrial, water and wastewater treatments. The only difference between these is the way they measure savings. You know, in the municipality will measure savings cost per square foot, same with residents, C&I. But water or some industrial agencies will measure it in terms of units, widgets, the number of widgets. Water treatment facilities measure it in gallons per day. So we had to modify some of the language in this tool to address the way the project is being marketed to the client, the end user. I have mentioned many times it calculates the cost of delay, and it contains 2 counterintuitive conclusions. And I've heard this directly from some of the CFOs of the largest school districts in the United States, the largest counterintuitive conclusions. Installing today and paying interest is a better financial decision than waiting for a future capital budget and thereby avoiding all interest. Oh, we hate paying interest. I'm not going to pay interest for this. That's not what we do. We hate it. Well, this tool can help you overcome that. And it also can help you understand how a lower interest rate may not always be the best financial deal. And we're going to go through that as well in this tool. 2 counterintuitive conclusions. Now, normally I would ask people to read this out loud if we're in a group in a classroom together and we're paying for energy efficiency projects, whether or not you do the project, what do we mean by that? And I would normally ask somebody from the audience to answer that question. Well, you can decide to do the energy project or delay doing the energy project. So if you do not do it, or if you delay it long enough, you continue paying the inefficiencies back to the electric and gas or water utilities. So you can choose, do I keep on paying the inefficiencies and losing those benefits, or do I initiate the project, start capturing the savings, and use those savings to pay for the investment? When you download the tool, this is the first sheet. It's a tool that's been developed on Excel, and I suspect most of you are familiar with Excel. You know, we have our tabs on the bottom: introduction, instructions, data entry, investment value, cash flow, interest rates, and a summary report. When you go into the tool, you start with your data entry tab. Now this shows you some yellow backed fields and some blue backed fields. If the field is highlighted in yellow, it means you can overwrite that field and put in your own data. And if it's in blue, it's a calculated field. You cannot change that. And note that, you know, if you change any of the options here, it will wipe out whatever data you put in. So we suggest that you download this tool, work on your local computer, be it a laptop or office computer, and work directly, keep it local, don't do it online. So the first thing is to select the type of analysis we're going to do. Now, I'd mentioned that we've opened it up for different types of organizations. And this is where you would start picking what basic guidelines we're going to use. Is it user-generated categories where you can, it's totally open. You can create whatever you want, however you want. Are you using benchmarking results from the portfolio manager? You can import those and put them directly into the tool. Or are you doing a lead EB project? So it's got language that ties into your lead, water, wastewater. Now we're dealing with, instead of cost savings per square foot per million gallons of water, whether you're doing an efficiency project so you can deal with your upgrades and tune-ups, or if you're a manufacturing facility or an entity. So pick whatever category works best for you. And we have some of the fields already labeled for you, so it gives you a head start. And in this case, we're starting with the portfolio manager. So we're going to be taking the data that we pulled, and we're going to enter it into top performer, 75, 50 to 74, 25 to 49, and below 25. So if you're familiar with the portfolio manager, that's giving you the quartiles where the projects fall, the buildings fall. And in this case, we're looking at the utility cost per square foot, 200,000. So the total utility bill is $1 million. And as you can see how it breaks out by the equipment that's linked into those different 4 categories, the annual utility costs, simple translation, cost per square foot, again, a calculated field. Now this one is where we're going to get your input. What do you expect to save in the 75% category or greater? Obviously, if that equipment is performing fairly well, maybe harder to capture savings compared to the below 25, the energy hogs, where you can capture more savings, in this case 40%. So we'll add all of those, label them all in, and we will come to a weighted balance average. In this case, we're looking at saving $425,000, assuming that our numbers are correct. And we're going to take that, and what are we going to do with those savings? We're going to leverage them. So the investment value tab is our leverage tab. So how do we leverage it? Well, we're going to use that to pay for the financing. In order to pay for financing, we need to add some additional points. We need an interest rate. We need a term. We need to know how much of the savings we're going to use to pay for the project. Now, we dealt with the school district on the West Coast that wanted to use some of the savings to rehire school teachers that they had lost due to budget cuts. So these are decisions that each organization can make on their own. The example we're using here is 90%. And in this case, there is a rebate of $100,000 in this particular project. So how much can we buy with the projected savings of $425 a year based on all of these terms? And you do that by pushing the calculate button here on the right-hand side. As you can see, the numbers shake out to be $2,845,000. So we can install $2.8 million of energy efficiency improvements without increasing our operating budget, and in fact generating a 10% savings that are going back to our operating budget. So we're doing these energy improvements all within the confines of the parameters of the technology that's being installed. Now, obviously, if you run the term out longer, you can install more equipment. But again, this is just an example. You plug in your own numbers and you will see exactly how these things shake out for you. In this case, 285. It's important to note that you see the very top of the chart here, we're carrying the data from the prior slide over, so you can see where these numbers come from. My favorite tab, the cash flow tab. Now, this is where the cost of delay kicks in. Again, we're carrying the numbers forward, but there are some new areas here that were not carried forward, and that's highlighted with the red box. Excuse me. So we're going to look at the new categories. How many years are we going to postpone the decision? Oh, we're not going to do it now. We're going to wait until next year's budget. Well, guess what? The project cost is probably going to go up due to inflation. And we know it's going to be next year. We don't know what it's going to be in year 3 and 4. The energy costs will be going up. We don't know exactly how much, but this gives you a chance to guesstimate it. And we have access to the property all year round. How quickly can we install the equipment? Good example is a school district. You can't install equipment when the kids are in school. So, the hours you have access to the property to do the work may be limited. So it gives us the option to reduce that. And now let's take a look at the results of our data entry. 2 options: A, fast tracking financing; B, waiting for cash. So as you can see here, the savings, well, we calculated that on the very first tab that we worked on. The project cost also we calculated. These are level monthly payments. So that's monthly payment times 12, as you can see here. And the difference between the two is your annual cash flow. But because we didn't have access to the property all the time, we're going to come up with a shortfall here. And we compare that to option B. We're going to wait for the budget. Well, you didn't do anything this year. 0's out. Our costs went up, but our savings went up a little bit. So we're going to write a huge check, and you're going to come out of pocket by $2.7 million in this example, but you get all of the savings back. You keep it all. You keep 100%. We don't want to pay that interest. We want to keep 100%. So the question now is, what's a better financial decision? Waiting till next year or entering into a financing agreement and doing it now? And clearly, the answer is obvious when you look at the net present value of the cash flows. If I finance it, the net present value of these cash flows is $688,000. But if I delay it and wait for a year, $404,000. So financing the deal generates 70% more cash than you would if you were waiting. This is a counterintuitive conclusion. Why does it work? Because what we're doing is we're rolling the cost of delay into the financial calculation. That's why this works. So we were dealing with a school district who had a 5-year, this is on the West Coast, 5-year energy efficiency rollout plan. When we walked through this particular page in the CFO calculator, they changed it, went out, they hired more ESCOs and vendors to get it done faster, because they recognized that this was in their best financial interest. Let's take a look at what happens if we delay the project for 1 year. I already showed you that $285,000. That's 10% of the project cost. But what happens if you do it for 2 years? That's 24% of the project cost. So these numbers, they're not linear. This is really an important schedule here that is very helpful when you're dealing with your financial folks, to get them to understand that time is of the essence when we're dealing with energy efficiency. Now, the last tab, the interest rate tab, is a little bit more esoteric, but this is one that I've actually used in Chicago on behalf of one of our clients. And this was a building owned by a Fortune 50 company. And we went in there and we said, this is the financing that comes through the vendor and the vendor program. And they said, no, if we are huge, if we wait until next year, there is a cost that gets applied. If we use our capital budget, gets charged back to us. But we're better off waiting. So I walked them through this tool. In this example, 7% is what they're offered. They can do it for 4.5%. The cost of the equipment, $2.8 million. What does that savings translate into? Well, here you go. $342,000. How do we come up with that? Well, we look at the loan payment at 7% over the same term, 10 years. We take the difference between the loan payment at 7% versus the loan payment at 4.5%. Take that difference, we take the net present value back of that difference, and that's where this number comes from, $342,000. That's what we pour into our bucket. We put that bucket into this column over here, and we ask the question, how long can you wait before the lower interest rate costs you more money? And in this example, and that spread 4.5 to 7, it's a fairly large spread. So we calculated the amount that we save in our utility bill in the very first tab, and we're just deducting every month that we wait from that bucket of savings until we hit the break-even point. In this case, 9.7 months. So if I have to wait, more than 9.7 months, maybe I should just go ahead and do the financing. If I had reduced the spread between 7% interest and 4.5%, that spread number, the number of months, would come down considerably. And that's the next counterintuitive conclusion. Lowest interest rate is not always the best deal until you bundle in the cost of delay into the calculation, and that's what this does. There's a report at the very end, restates everything. I happen to like the fact that you can print out an individual page and not have to print out the whole report if you don't want to. That underscores the argument of the challenge that you're dealing with at any particular time. Where do you find these tools? This is the EPA.gov Energy Star website. Click on commercial buildings, or go to the next one, go into commercial buildings, go down to resources by topic, click on that. Go down to the F categories, and that is where you will find financing, obviously. Click on that, and you'll see that there's a variety of tools that you can access from here. And of course, if we're looking at the energy efficiency models, you can get that from this particular web page. And if you drill down a little bit more, that's where you pick up the cash flow opportunity calculator. As I mentioned, it's built on Excel, and you should download it and work off of your local computer. So if you like that financial calculator and the calculation, the concept, we've written a paper, so you can do your own. You don't have to follow ours. You can create your own, because our calculation is done at a very high level. It's done from 10,000 feet. But you have a project that you maybe want to look at that has different installation schedules. You have different savings that kick in at different times. So you can create your own spreadsheet. All of the calculations and methodologies are written up here. And I strongly suggest that if this is something of interest, by all means, take full advantage of it. If you have trouble understanding it or working through it, my phone number and contact information is at the end. Feel free to give me a call. I'll be happy to help you. Now, we've written some additional documents that are available on the website as well. It's a document we wrote, Financial Speak for Facility Managers. I think you may find helpful. And the Energy Management Guidance Financial, of course, is the topic. I'm going to give you a reminder here that some tools that are very important. Portfolio Manager. If you have not signed up for using it, there are webinars all the time that will introduce you to the tool and get you started. If you're doing a retrofit, as I had mentioned earlier, and you're trying to seek savings and tax credits, you really need to be familiar with that Portfolio Manager tool. It's worth its weight in gold, literally. And if you're looking at trying to figure out what to do, how to maximize your savings. The Target Finder is another great tool that helps architects and engineers, building owners, of course, to assess the performance of building designs in existing buildings. So another very good tool, readily available from the website. Here's our list of additional resources. I alluded to some of them. If you're looking for where to find money, the DOE Financing Navigator is a great tool. So they list different lending institutions that are familiar with energy efficiency improvements. Now, it's a limited list. It doesn't include them all because there are a lot of smaller lenders that DOE has not picked up because it's mostly focused on very large projects. But this is a great starting point. In addition to NASIO State Energy Office, to find rebates, two suggestions here, Energy Star Rebate Finder, and of course the Utility Genius Rebate Finder. That's a third-party application to see where you can maximize any rebates on any project that you're working on. And we've reached the end of today's talk. Again, I apologize for my voice. I'm getting a little bit hoarse, and I woke up with a little bit of laryngitis this morning, and I suspect it's coming through on today's talk. I apologize. So I see one question. Is EUI measured by square feet? The answer is yes. It is measured by in square feet. Now, if you're dealing with a retrofit, again, we're back to the portfolio manager. If you plug your data into that portfolio manager, it will do all those calculations for you. So do I have any other questions?
Yeah, looks like there's one more question for EAAS. We should avoid quote unquote operational lease language in favor of quote unquote capital lease language. Is that right?
Read that again.
For EAAS, we should avoid operational lease language in favor of capital lease language. Is that right?
No, it's a different animal. It's a different animal. Energy as a service, what you're doing is you're basically giving the responsibility to a third party to take over, own, and manage your energy portion of your operations. So however they decide to finance it, it's no longer your problem. It's a service. It's like paying for somebody to come in and clean your windows. You know, you're paying an ongoing service fee for cleaning the windows. Well, in this case, you're paying an ongoing service fee for maintaining your best maximizing your energy savings through the management of your energy assets. So you wouldn't really get involved with a lease or any other financing agreement because that's totally taken care of by the entity that's underwriting the EAAS. Does that make sense? Any other questions? I hope I answered that.
Doesn't seem like there's any other questions right now. I do encourage attendees to put in any questions you have in the chat. Looks like we're almost at time here, so any last minute questions?
Yeah, and if you think of a question later, don't hesitate. Right, you know, you're going to get a copy of the presentation. My contact information is there. Kudret Utabe works with ICF. He is one of the managers of these programs, and we all report back to Katie Hatcher, who's the national manager for public sector at EPA. So we're all here to help you. We are funded by EPA, so this is not a solicitation. You know, we want to help you, and we hope that if we can help you do your energy improvements and make it happen faster, we all win. If you wish to get some recognition, you know, if you're doing a project you think is really cool, you know, contact us. We'd love to write it up as a case study. So, you know, if you're doing something that merits additional viewing, you know, don't be shy. Let us know. And I'd like to thank everybody today for showing up. And I appreciate the fact that you've shared an hour and a half of your afternoon with us today. And I wish everybody, the best. Keep your eyes on your crystal balls. Nobody knows what's going to happen with the future of financing projects. I suspect, as I had mentioned earlier on, not much will change in terms of projects that have already been allocated or funding. That will not change. Congress can't change that. To make any big changes in the IRA, this is going to have to be done by Congress. And who knows what's going to happen there? I have no idea. My crystal ball doesn't work very well. But what I can say is a lot of these projects, especially renewable energy projects, are happening in red states. And you're going to find a lot of the senators and congressmen, congresspeople are anxious to continue promoting these. So I suspect, and again, this is just a guess, that a lot of these programs will continue on into the future. Which ones and how much, God only knows. But I think that, keep the faith, baby, as they used to say. So on that note, I'd like to thank you all, and I wish you all a great week.
Thank you, everyone, and thank you, Neil, for a wonderful presentation.